Welcome to China Perspectives, a podcast on economic and credit developments in China, featuring experts from within and outside of Fitch Ratings. My name is Jeremy Zook, lead China sovereign analyst at Fitch, and co-host of this podcast. In today's episode, we will be taking a deep dive into a range of issues surrounding local government financing vehicles, or LGFVs, and local government debt positions. Recently, there has been a renewed effort to rein in the growth of off-balance sheet LGFV debt and to address local government fiscal challenges. Today, we will discuss some of those efforts, looking at some of the progress that's been made so far, lingering challenges, and potential rating implications for the LGFV and local government sectors. This is, of course, a pretty important topic with implications beyond just these sectors as well. In early April, Fitch downgraded the China sovereign rating to A from A+ to reflect rapidly rising government debt coming in part from local governments, as well as lingering contingent liability risks, especially from LGFVs. Joining me today to discuss these issues is Harry Hu, a senior director on Fitch's international public finance team. Harry has been with Fitch for several years now and has focused on local government issues in China for a number of years prior to joining Fitch. Thank you for joining us today, Harry.
Thank you for having me.
So to start out, I wanted to begin with just an overview of some of the measures that the government has taken to rein in some of the LGFV debt growth. How effective are these LGFV debt control policies, and what debt growth trajectory are you expecting?
Yeah, that's a good question, Jeremy. So yes, debt control is taking place, but maybe not as some news reports suggest. Based on our calculation, LGFV bonds grew by 3% in 2024. This includes around 370 entities that have reclassified from LGFVs to industrial companies. But for these reclassifications, we'll see a decline by about 6%. We think the primary reason behind this reclassification is to get around some bond issuance restrictions that were first put in place around middle of 2023. These companies, now reclassified, have about 2.5 trillion RMB in bond balances and 12 trillion RMB in interest-bearing debt. That's why there's a sizable gap between our calculation and what's being reported. After these companies changed the classification, we've seen the bond balances jump by 11%, much higher than the 3% for the sector. We believe more LGFVs are yet to reclassify. It's a development that is worth monitoring. So at the end of the day, taking reclassification into account, we expect LGFV debt won't be negative for growth. Instead, it is going to be positive, though the speed will be slower compared to before.
So yeah, this is a very interesting issue around LGFV reclassification, and I know your team has done a bit of research into this topic. Can you expand a bit further on LGFV reclassification? To what extent has there been actual substantial change to LGFV profiles? And are there any implications for their policy roles or for government support that you currently assign in their ratings?
Let me first expand on this interesting reclassification topic by outlining which provinces have the most. So far, Shandong, Sichuan, Fujian, Henan, Guangdong are leading. This tells us that reclassifications is not really related to the 12 regions and the strict debt control. This is because those areas are under general debt quarantine by the central government. So reclassification doesn't really help them, the LGFVs in those regions, in issuing new bonds for growth. On whether there have been actual changes in the profiles to substantiate these reclassifications, we have done some homework. We cross-checked against our rated portfolio and found that 34 of these 370 companies are rated by Fitch. We do not believe these companies have undergone significant business change. For instance, nearly half experience actually increases in policy-intensive business, such as urban development and public utilities investment. We believe business transformation takes a while and is unlikely to be completed over a year or even 2 years. This reclassification doesn't really affect our view on LGFV's roles or government support in the ratings. From what we can see, these are more like label changes, where the entities continue to function as LGFVs, despite being classified differently.
Speaking of government support, in November, the government outlined a debt substitution plan that is currently underway, where local governments are essentially bringing LGFV debt onto their balance sheet. How do you see this latest round of LGFV debt substitution, and is this a sign of potentially higher support in your rating construction?
So when we talk about the latest round of LGFV debt substitution program, it is important to recognize what's happening. The government is trying to ease the pressure on LGFVs by swapping their debt with local government bonds. It reduced the immediate debt burden of LGFVs, but it doesn't really tackle the structural fiscal issues that local governments face. One limitation is that the program only targets hidden debt classified by the Ministry of Finance. Hidden debt refers to debt borrowing, usually by an LGFV, to finance public investments, typically projects without meaningful operating cash flow. The program, however, doesn't cover LGFV debts outside of this scope, which includes other quasi-policy investments. For example, and this is hypothetical, a sports stadium, it has some receipts, but not enough to cover its running costs. Debt like this, project like this, for example, they have some but less than adequate operating cash flows. And in total, the debts are quite substantially larger. And there isn't an explicit official response on this. In terms of how we look at the program, the debt substitution effectively moves LGFV debt onto the LRG or the local government's balance sheet. It does not increase Fitch's estimation of the overall LRG's responsibility to service public sector obligations. This latest round of debt substitution aligns with our already factored in expectation that the authorities will maintain support, and this is already incorporated in our rating methodology.
I want to turn now to the more explicit local government balance sheets. We've seen sustained high growth in local and regional government special purpose bond issuances. Do you expect this trend to continue? And what are the main areas that local governments are investing in with the proceeds from these SPBs? And are these projects on track to deliver, say, more adequate financial returns going forward?
Local government direct debt has been rising rapidly, averaging around 24% annually over the past 4 years. And special purpose bonds, or SPBs, account for 85% of new issuances. This has driven up interest expenses for LRGs despite lowering interest rate conditions. To what extent, you might ask? The interest expense is now around 8% of LRG's total capital expenditure, and we project this to reach 10% by the end of this year. This is a significant jump from 2.9% only back in 2019. So let me take you a bit back in memory lane. Remember when SPBs were first rolled out? It was done on the basis that project income should cover principal and interest over the course of the project. The expectation is that the coverage should be at least 1.2 times. However, at this stage, that coverage is only 0.6 times. You might say, they maybe just need a bit more time to get it over the line. Sure. But there is difficulty in achieving this from the current level, especially with the economic pressures and property market slump, which inevitably is linked to infrastructure project incomes. So what is done in the meantime? Refinancing at longer maturities seems to make some sense, buying more time for the project to generate more income, and also for new projects to be more profitable. I guess this is a good segue into your second part of your question. So which areas are the funds being invested? Around 40% is in infrastructure and industrial parks, 14% in transportation. Project cash flow sources may include operating revenue, subsidies, asset disposals, land sales, but for the last part, it is sensitive to how the Chinese real estate market develops over the next few years, so we have to see how that goes. There is interest payments pressure, of course, but there's also compensating factors and controls. For example, greater fiscal flexibility, especially the use of fiscal subsidies and other project revenues to service SPBs when project incomes are insufficient. However, at the end of the day, this is not project income, and profitability of SPB finance projects is paramount. So even the government has to make a return.
And as these SPB balances grow at a fairly high pace, interest payments may also be rising. How do the various provinces fare in regards to their interest burden? And are there any pressures that you see building?
Let me start with some high-level policy developments. The State Council has emergency response plan for local government debt risks. If a local government's annual interest expense reaches 10% of its operating or capital expenditure, it triggers a fiscal restructuring plan. Provinces experiencing high pressure from interest payments must adopt stricter debt control or possibly reduce investments. Amongst the 12 provinces identified by the central government as key regions for debt resolution, 10 have interest payments exceeding this 10% threshold. This is of course correlated with interest payment pressure. Provinces like Heilongjiang, Tianjin, Qinghai, Gansu, Liaoning, and Yunnan are unable to cover the SPB interest expense with their project revenues. In contrast, eastern coastal cities like Zhejiang, Shanghai, and Jiangsu can cover SPB interest expense at twice the national average. For weaker provinces, they will need to cut investments or use alternative fiscal revenues to ensure they have enough resources to repay interest. This could affect the long-term economic development, potentially widening the gap with more developed regions. Personally, this greater dose of investment prudency may be more suitable amidst the current economic conditions. After all, incurred debts have to be repaid at some point, and interest payments have to be funded from somewhere.
Thank you, Harry, for joining us today and sharing your perspectives. This has been an incredibly insightful conversation, and we've touched on a number of issues that will be critical to keep an eye on over the coming years to see how the authorities continue to manage these local government fiscal issues and challenges going forward. I want to also just flag that you can find Harry's team's report on the reclassification of Chinese LGFVs on fitchratings.com, and keep an eye out, of course, for future research that will be coming your way from Harry's team. You've been listening to Fitch Ratings, China Perspectives podcast. To learn more about our ratings and research on China, visit us at fitchratings.com. And please subscribe to China Perspectives on iTunes, Spotify, or wherever you may get your podcast. Take care until next time.